$50 billion. That is not a metaphor. That is not clickbait. That is not a rounded number for a dramatic effect. That is the actual notional value of silver exposure sitting on COMEX right now, $50 billion. And every single day that passes in January, that exposure gets more dangerous. Every single hour, the risk compounds. Every single minute, the fuse burns shorter. They want you to believe COMEX is stable. They want you to believe the paper market can handle anything. They want you to believe $50 billion is just another number on a balance sheet that accountants manage with spreadsheets and risk models. They are wrong. Because what most people do not understand, what most traders do not see, what most investors completely miss, is that $50 billion in silver contracts is not backed by $50 billion in physical silver sitting in vaults waiting to be delivered. It is backed by leverage. It is backed by margin. It is backed by faith. It is backed by the assumption that most contracts will settle in cash, not metal. It is backed by the belief that the system will never be tested all at once. But what happens when that assumption breaks? What happens when faith collapses? What happens when buyers stop accepting cash settlement and start demanding metal? What happens when the January effect, the single most powerful seasonal surge in physical silver demand, collides head-on with a paper market that has 15 times more claims than metal? That is the time bomb. That is the $50 billion bomb. And the fuse is not just lit, it is burning. Fast. While you were celebrating the new year, while you were watching fireworks and making resolutions, while you were scrolling through your portfolio wondering when silver would make the next move, the January effect started. And this January is not like any other January in history. This January, China has export controls live for the first time. This January, premiums in Asia are already at historic levels before the month even gets going. This January, COMEX registered inventories are sitting near multi-year lows while open interest is near all-time highs. This January, the $50 billion house of cards is already shaking. And most people have no idea. There is one missing detail in every article you read about COMEX silver. There's one missing detail in every analyst report about the futures market. There's one missing detail in every YouTube video that talks about silver shortages and squeezes and to the moon predictions. The missing detail is this. COMEX does not have $50 billion in physical silver. COMEX does not have 750 million ounces sitting in vaults ready to deliver. COMEX has a fraction of that, a small fraction. And when buyers realize that fraction is nowhere near enough, the entire system does not just correct, it implodes. So today, I'm going to take you inside the bomb. I'm going to show you the exact math, the real numbers, the actual leverage ratios that make this $50 billion structure a ticking time bomb. I'm going to show you why January is the most dangerous month for COMEX in decades. I'm going to show you the 5 triggers that could set off the explosion in the next 30 days. I am going to show you the 3 scenarios for what happens when the bomb goes off, and I am going to give you a survival playbook so you do not get vaporized when the detonation happens. Because this is not a theory. This is not speculation. This is not a, maybe this could happen if things get really crazy scenario. This is basic arithmetic. This is leverage. This is supply and demand. And arithmetic does not lie. Leverage does not bend. Supply and demand do not negotiate. When the numbers do not add up, the system breaks. And right now, the numbers do not even come close to adding up. Let's begin. Part 1, the $50 billion number, where it comes from, why it matters, and why most people have no idea how dangerous it is. Let me start by walking you through exactly where the $50 billion number comes from. Because when most people hear 50 billion, they think it is just a big, scary number thrown around to get attention. They think it is hyperbole. They think it is sensationalism, but it is not. It is a precise calculation based on publicly available data that anyone can verify. And once you see the math, you will understand why this number is not just big, it is catastrophic. Here's how it works. COMEX, the Chicago Mercantile Exchange, trades silver futures contracts. Each silver futures contract represents 5,000 ounces of silver, not 500, not 5,000 pounds, 5,000 ounces. That is the standard contract size. Now, as of early January 2026, the open interest in COMEX silver futures is running at approximately 150,000 contracts. Open interest means the total number of contracts that are currently active in the market, contracts that have been opened but not yet closed. So 150,000 contracts. Each contract is 5,000 ounces. Let me do the math for you. 150,000 contracts times 5,000 ounces per contract equals 750 million ounces of silver. 750 million ounces. That is the total amount of silver that these contracts represent. That is the notional exposure. Now, let me convert that into dollars so you understand the scale. Silver is currently trading, let's use a round number for simplicity, at approximately $75 per ounce. 750 million ounces times $75 per ounce equals $56.25 billion. $56 billion. That is the total dollar value of all the silver represented by open interest on COMEX right now. That is the $50 billion bomb. Now, here's the first problem. The first crack in the foundation, the first sign that this entire structure is built on sand. COMEX does not have 750 million ounces of silver sitting in vaults available for delivery. Not even close. As of the most recent publicly available data you can check yourself on the CME Group website, COMEX registered silver inventories are sitting at approximately 50 million ounces. 50 million ounces. Not 750 million, 50 million. Let me say that again so it sinks in. The paper market has claims on 750 million ounces. The physical market has 50 million ounces available for delivery. That is a ratio of 15 to 1. 15 paper ounces for every 1 physical ounce. 15 claims for every 1 bar of metal. 15 promises for every 1 delivery. Now, you might be thinking, okay, but that is how futures markets work, right? Most contracts settle in cash. Most traders do not want metal. They just want price exposure. So the 15 to 1 ratio is normal. And in a normal market, you would be absolutely right. In a normal market, most contracts do settle in cash. Speculators trade silver futures the same way they trade stock index futures or oil futures or currency futures. They do not want the underlying asset. They want exposure to price movements. They want to profit from volatility. So they open contracts, they trade them, they close them before expiration, and they take their profit or loss in cash. No metal ever changes hands. No delivery ever happens. The system works because the vast majority, typically 95% or more, of contracts are closed out before they reach the delivery phase. And COMEX only needs to have enough physical metal in registered vaults to satisfy the small percentage of contracts that actually stand for delivery. That system has worked for decades, but it only works under one critical assumption. The assumption is that delivery demand remains predictable, stable, and manageable. The assumption is that the 5% delivery rate stays at 5%. The assumption is that the physical inventory in registered vaults is always sufficient to cover that 5%. But what happens when that assumption breaks? What happens when the delivery percentage starts to rise? What happens when buyers stop trusting cash settlement? What happens when physical demand surges and buyers want metal, not contracts? What happens when the 5% becomes 10% or 15% or 20%? That is when the 15 to 1 ratio stops being a feature of the market and starts being a fatal flaw. Let me show you the math. Right now, COMEX has 150,000 contracts in open interest. If 5% of those contracts stand for delivery, that is 7,500 contracts. 7,500 contracts times 5,000 ounces per contract equals 37.5 million ounces. COMEX has 50 million ounces in registered inventory, so the market clears. No problem. Delivery happens smoothly, the system works. But what happens if the delivery percentage rises to 10%? 10% of 150,000 contracts is 15,000 contracts. 15,000 contracts times 5,000 ounces equals 75 million ounces. But COMEX only has 50 million ounces. That is a shortfall of 25 million ounces. 25 million ounces that do not exist in the registered vaults. 25 million ounces that cannot be delivered. 25 million ounces that create a crisis. Now you might say, but surely COMEX has ways to deal with that. They can source metal from eligible vaults. They can borrow metal from dealers. They can increase margins to force contracts to close. They have risk management tools. And you would be right. COMEX does have tools, but tools only work if the problem is temporary. Tools only work if the spike in delivery demand is a one-time event caused by speculation or a short squeeze that resolves quickly. But what if the spike in delivery demand is not temporary? What if it is structural? What if it is driven by real physical demand that is not going away? What if it is driven by the January effect? That is when the tools stop working. That is when the 15 to 1 leverage ratio stops being manageable and starts being a death sentence. And that is exactly what we are facing right now. Let me explain why January changes everything. January is not just another month in the silver market. January is the month when physical demand surges across every category. Industrial demand, jewelry fabrication, investment flows, cultural buying in Asia, all of it hits at the same time. And this January, that demand surge is colliding with a supply chain that is already under extreme stress because of China's export controls. So let me walk you through the January effect in detail. Because once you understand what happens in January, you will understand why the $50 billion bomb is about to explode. Part 2. The January effect, the perfect storm of demand that hits every single year, and why this year it is colliding with a supply chain that cannot respond. Now let me take you inside the January effect. Because the January effect is not just a seasonal trend that traders talk about, it is a structural shift in the silver market that happens every single year like clockwork. And this year, that shift is happening in an environment where the supply side is fundamentally broken. Let me walk you through the 4 drivers of January demand. Driver 1, jewelry fabrication. The jewelry industry operates on a very specific production cycle. During the holiday season, November and December, jewelry manufacturers slow down their raw material purchases. Why? Because retail demand during the holidays is focused on finished goods. Consumers are buying jewelry that is already made, already polished, already in the display case. Manufacturers are not fabricating new jewelry in December. They are selling the inventory they made in October and November. So raw silver purchases drop during the holiday period. But in January, everything changes. In January, jewelers start preparing for the spring and summer season. They start designing new collections. They start fabricating new pieces. And they need raw silver to do that. So they place large orders with suppliers. They lock in metal early before the price moves. They overorder to make sure they have enough inventory for the next 6 months. And all of that buying hits the market in a concentrated window in January. This is not a small amount. The jewelry industry is one of the largest consumers of silver in the world. And when jewelers restart fabrication in January, they do not buy small quantities. They buy in bulk. They buy by the ton. And that creates a surge in physical demand that the market has to absorb. Driver 2, industrial demand. Industrial demand for silver works the same way. Many factories and manufacturing plants shut down or slow production during the December holiday period. Why? Because of the holidays. Workers take time off. Supply chains slow down. Shipping schedules are disrupted, so production slows. And when production slows, raw material purchases slow. But in January, factories reboot. Production ramps back up to full capacity. And manufacturers need silver to keep the lines running. Electronics manufacturers need silver for circuits, switches, and components. Solar companies need silver for photovoltaic cells. Medical device manufacturers need silver for antibacterial coatings. Automotive companies need silver for sensors and electronics in electric vehicles. All of that industrial demand comes back online at the same time. And industrial buyers do not care about the spot price. They do not sit around waiting for a dip. They need metal to keep their factories running. So they pay whatever price is necessary to secure supply. They pay premiums. They lock contracts. They overorder to avoid shortages later in the year. And that creates another surge in physical demand that hits the market in January. Driver 3, investment demand. January is also when investment flows surge. Why? Because January is when individuals and institutions deploy capital for the year. Bonuses are paid in December and January. Tax refunds are planned. New portfolios are funded. Wealth managers sit down with clients and allocate capital for the year. And precious metals are a traditional January buy. Investors who have been sitting on cash in December start putting that cash to work in January. Retail investors buy coins and bars from dealers. Institutions add positions in silver ETFs. Hedge funds and commodity funds rebalance portfolios at the start of the year. And all of that buying creates a surge in demand. Now, some of that demand is paper demand, ETF shares, futures contracts, and other financial instruments. But a significant portion of it is physical demand. Retail investors do not just buy SLV shares. They buy American Silver Eagles. They buy Canadian Maple Leafs. They buy bars from dealers. And when retail buying surges, dealers have to replenish their inventory. And to replenish inventory, dealers buy from wholesalers. And wholesalers buy from refiners and mints. And refiners need raw silver to produce coins and bars. So the investment surge in January creates a ripple effect through the entire supply chain. Driver 4, cultural demand in Asia. This is the driver that most Western analysts completely miss. In Asia, silver is not just an investment, it is a cultural asset. And the biggest cultural event in Asia is the Lunar New Year. The Lunar New Year is one of the most important holidays in China, Vietnam, Korea, and other Asian countries. And silver plays a major role in Lunar New Year celebrations. Families buy silver as gifts. Businesses give silver to employees as bonuses. Temples purchase silver for ceremonies. And in China alone, Lunar New Year silver demand can spike by 30 to 50% during the weeks leading up to the holiday. Now, here's the critical detail. The Lunar New Year does not happen on January 1st. It is based on the lunar calendar, so the date changes every year. But it always falls in late January or early February. And this year, the Lunar New Year falls in late January. That means the demand surge happens right in the middle of the January effect. So you have jewelry fabrication ramping up, industrial demand restarting, investment flows surging, and cultural buying in Asia peaking, all at the same time. In a normal year, the market absorbs this demand by increasing supply. Refiners ramp up production, miners ship more metal, dealers increase inventory, the supply chain flexes to meet demand, and the market clears. Premiums might rise a little, delivery times might extend by a few days, but the system holds, the market works. But this year is not normal. This year, the supply side is fundamentally broken. And here's why. China controls 60 to 70% of the world's refined silver supply. Let me say that again. 60 to 70%, not 20%, not 30%, 60 to 70%. China is the largest producer of silver in the world. China is the largest refiner of silver in the world. China is the largest exporter of silver in the world. And on January 1st, 2026, China implemented export licensing controls on silver. That means silver exports from China are no longer automatic. They are conditional. They require government approval. They require licenses. They require paperwork. They require time. And most importantly, they require that the Chinese government prioritizes domestic demand over foreign buyers. So when the January demand surge hits, the supply side cannot respond the way it used to. In previous years, when demand surged, Chinese refiners would increase exports. Western dealers would place orders. Metal would flow, and the market would clear. But this year, when demand surges, Chinese refiners cannot just export more metal. They need permission. And if the Chinese government decides that domestic demand, jewelry, solar, electronics, cultural buying has priority, then exports get restricted. And when exports get restricted, the rest of the world has to compete for a smaller pool of supply. That is the structural break. That is why this January is different. And that is why the $50 billion COMEX bomb is sitting on top of a supply chain that cannot deliver. Now let me show you what happens when January demand hits a broken supply chain. Part 3, the math of the bomb. How 15 to 1. Leverage becomes a death spiral. Now let me show you the exact math of how this bomb explodes. Because this is not a vague something bad might happen scenario. This is a mechanical process that can be calculated. Let me walk you through it step by step. Step 1. Current open interest. As of early January, COMEX silver futures open interest is approximately 150,000 contracts. 150,000 contracts times 5,000 ounces per contract equals 750 million ounces. That is the total notional silver exposure. Step 2. Registered inventory. COMEX registered silver inventory is approximately 50 million ounces. That is the metal available for delivery. Step 3, the leverage ratio, 750 million ounces of paper exposure divided by 50 million ounces of registered inventory equals 15. That is a 15 to 1 leverage ratio. 15 paper ounces for every 1 physical ounce. Now, in a normal market, that leverage is fine, because only a small percentage of contracts stand for delivery. Let's say 5%. 5% of 150,000 contracts is 7,500 contracts. 7,500 contracts times 5,000 ounces equals 37.5 million ounces. That is below the 50 million ounces in registered inventory. So the market clears, no problem. But what happens if the delivery percentage rises? What if January demand pushes the delivery percentage from 5% to 10%? 10% of 150,000 contracts is 15,000 contracts. 15,000 contracts times 5,000 ounces equals 75 million ounces. But COMEX only has 50 million ounces in registered inventory. That is a 25 million ounce shortfall. Now, what does COMEX do? Option 1, force cash settlement. COMEX changes the rules and forces contracts to settle in cash instead of metal. But that destroys confidence in the market. It confirms that the paper market is a fraud. And it triggers a rush to convert paper to physical everywhere else. Option 2, raise margins. COMEX increases the margin requirements for holding contracts. That forces speculators to liquidate. Open interest drops. Delivery demand drops. The crisis is delayed, but the problem is not solved. It is just pushed forward. And the next month, the same dynamic repeats. Option 3, metal flows in from other sources. Dealers ship metal to COMEX vaults. Registered inventory rises. The shortfall is covered. The market clears. But where does that metal come from? It comes from dealer inventories, retail supplies, ETF redemptions. And all of those sources are already under stress. So even if COMEX survives January, the broader market gets tighter. Premiums rise everywhere. Delivery delays extend. And the next wave of demand hits an even weaker structure. That is the death spiral. Now, let me show you what happens if the delivery percentage rises even further. What if January demand is so strong that 15% of contracts stand for delivery? 15% of 150,000 contracts is 22,500 contracts. 22,500 contracts times 5,000 ounces equals 112.5 million ounces. But COMEX only has 50 million ounces. That is a 62.5 million ounce shortfall. At that point, the market does not just tighten, it breaks. Because there is no way to cover a 62.5 million ounce shortfall in the middle of January. The metal does not exist, and even if it did exist somewhere, it cannot flow fast enough to satisfy delivery demands within the contract settlement window. That is when the bomb goes off. That is when COMEX defaults, not because they refuse to deliver, but because they physically cannot deliver, and that is the difference between a market correction and a market collapse. Now, you might say, but surely COMEX has risk management systems to prevent this. And you would be right. COMEX does have risk management systems. They can raise margins. They can impose position limits. They can halt trading. They can force liquidation. But all of those tools assume that the underlying problem is speculative excess. They assume the problem is too many longs chasing a move. But that is not the problem this January. The problem this January is not speculative excess. The problem is structural supply deficit. And you cannot fix a supply deficit with margin hikes. You can only delay the reckoning. And every day you delay, the deficit gets worse. Because January demand is real demand. It is not speculative froth. It is jewelry fabrication, industrial restocking, investment flows, and cultural buying. That demand does not go away just because COMEX raises margins. It just shifts to the physical market. And when it shifts to the physical market, premiums explode. Dealers run out of inventory. Mints allocate product. Delivery times extend from days to weeks to months. And the paper price becomes irrelevant. Because the paper price is the price of a promise, but the physical price is the price of the metal. And in a supply deficit, the metal is all that matters. That is the math of the bomb. That is how 15-to-1 leverage becomes a death spiral. And that is why $50 billion in paper exposure is about to blow up COMEX. Part 4. The triggers. What could set off the bomb in the next 30 days? Now, let me walk you through the specific triggers that could set off this bomb in the next 30 days, because the bomb does not explode on its own. It needs a catalyst. And there are at least 5 catalysts that could hit this month. Trigger 1. A large institutional buyer stands for delivery. This is the most obvious trigger. If a major institution, a sovereign wealth fund, a pension fund, a central bank, or a large industrial buyer decides to take physical delivery of a large position, it could drain COMEX registered inventory in days. Let's say a single buyer stands for delivery on 10,000 contracts. 10,000 contracts times 5,000 ounces equals 50 million ounces. That is the entire registered inventory. In one move, gone. Now, COMEX would try to source more metal from eligible vaults or outside warehouses, but that takes time. And if the buyer wants immediate delivery, COMEX is in default. That is trigger 1. Trigger 2, a delivery squeeze driven by Asia. If Asian buyers, particularly Chinese or Indian buyers, surge into the physical market and start bidding aggressively for immediate delivery, it could create a feedback loop. Dealers ship metal to Asia to capture premiums. That drains Western inventories. COMEX registered inventories drop. Speculators see the drain and start standing for delivery to front-run the squeeze. That accelerates the drain. And the squeeze becomes self-reinforcing. That is trigger 2. Trigger 3, a margin hike that backfires. COMEX could try to prevent the squeeze by raising margins. Higher margins force speculators to liquidate. Open interest drops. Delivery risk drops. But if the margin hike is too aggressive, it could trigger panic. Longs interpret the hike as a sign that the exchange is worried about delivery. They rush to stand for delivery before the metal runs out. And the margin hike, instead of reducing delivery risk, actually increases it. That is trigger 3. Trigger 4, a major ETF redemption. If a large silver ETF experiences a wave of redemptions, it has to sell physical silver to raise cash. That silver leaves the market. And if that silver was part of the pool that dealers rely on for delivery, it shrinks the available supply. That tightens the market further. And if the timing coincides with the January demand surge, it could push COMEX over the edge. That is trigger 4. Trigger 5, a geopolitical shock. If a major geopolitical event disrupts supply chains, it could accelerate the crisis. A conflict in a silver-producing region, a sudden tariff or trade restriction, a natural disaster that shuts down a major refinery. Any of those events could reduce the flow of silver into the market at exactly the wrong time. And when supply is already tight, even a small disruption can trigger a panic. That is trigger 5. Part 5, the scenarios. What happens when the bomb goes off? Now let me walk you through the 3 scenarios for what happens when this bomb goes off. Because the bomb does not just explode and then disappear, it creates shockwaves. And those shockwaves ripple through the entire silver market. Here are the 3 scenarios. Scenario 1, controlled detonation. In this scenario, COMEX sees the crisis coming and takes preemptive action. They raise margins early. They work with large holders to roll positions forward instead of standing for delivery. They coordinate with dealers to source metal from outside the registered vaults, and they manage to get through January without a default. The market tightens, premiums rise, delivery times extend, but the system does not break. This is the soft landing. The crisis is delayed, not solved, and the same dynamics return in February, March, and April. But the system survives January. Probability, medium. This is the outcome COMEX is fighting for. Scenario 2, partial default. In this scenario, COMEX cannot source enough metal to satisfy all delivery demands. They default on a portion of contracts. They force cash settlement on some holders. They impose emergency rules. They halt delivery temporarily. The market panics. The paper price crashes as confidence collapses, but the physical price explodes as buyers flee to metal. The disconnect between paper and physical becomes extreme. The COMEX market loses credibility permanently. This is the fracture. The paper market continues to exist, but it becomes a side bet. The real market moves to physical, probability, medium to high. This is the scenario most people are not prepared for. Scenario 3, full collapse. In this scenario, the delivery squeeze is so severe that COMEX cannot function. Multiple large holders stand for delivery at the same time. Registered inventory goes to zero. Dealers cannot source replacement metal fast enough. COMEX is forced to halt trading entirely. The futures market shuts down, and the entire global silver pricing mechanism breaks. At that point, there is no spot price. There is only negotiated price. Buyers and sellers transact directly. Premiums vary wildly by region, and the market enters a period of complete chaos. This is the nuclear option. This is the scenario where the entire paper market dies. Probability, low to medium. This is the doomsday scenario, and while it is not the most likely outcome, it is not impossible either. Now, here's what you need to understand. Even in scenario 1, the controlled detonation, you still see major market disruption. Premiums rise sharply, delivery times extend, physical availability tightens, and the paper price becomes less relevant. So even the best case scenario is still a major shift. And in scenarios 2 and 3, the shift is seismic. The paper market either loses credibility or collapses entirely. And when that happens, the only thing that matters is physical ownership, not contracts, not ETFs, not futures, metal, bars, coins, physical silver. That is the endgame. And January is when we find out which scenario plays out. Part 6, the playbook. How you survive the $50 billion explosion. Now I'm going to give you the survival playbook, because the worst thing you can do is watch the bomb explode and not know what to do. Here's the clean framework. Rule 1, if you own paper silver, make a decision now. Do you believe COMEX can survive the January effect? If yes, you hold your paper and ride the volatility. If no, you convert paper to physical while you still can, because once the bomb goes off, conversion becomes difficult, premiums explode, dealers limit sales, delivery times extend, and the metal becomes scarce. So if you believe scenario 2 or 3 is coming, you convert now. Rule 2, if you own physical silver, this is your confirmation. You are holding the asset that cannot be printed. You are holding the asset that COMEX cannot deliver. You are holding the asset that the market will scramble for when the bomb goes off. The paper price may crash. The headlines may scream correction, but if COMEX is in a delivery crisis, your metal is worth more, not less, because the physical market will decouple from the paper market, and the physical price is the real price. Rule 3, watch registered inventory daily. This is the countdown clock. If COMEX registered inventory starts dropping sharply, the bomb is armed. If it drops below 40 million ounces, the fuse is lit. If it drops below 30 million ounces, the explosion is imminent. This is the most important data point in the entire market right now. Not the price, not the open interest, the registered inventory. Rule 4, watch premiums in Asia. If Shanghai premiums spike above $15 or $20 over COMEX, the market is fracturing. If Tokyo premiums hit similar levels, the fracture is spreading. If those premiums hold for more than a few days, the fracture is structural. That is the signal that the paper market is losing control. Rule 5, do not try to trade the explosion. This is not a trade. This is a survival event. You cannot short the bomb. You cannot arbitrage the chaos. The only winning move is to be on the scarce side of the market before the bomb goes off. And the scarce side is physical. Rule 6, prepare for volatility. The bomb does not explode in a straight line. There will be whipsaws. There will be fake breakouts. There will be margin-driven sell-offs. There will be headlines that say, the crisis is over. Do not get shaken out by the noise. The bomb is structural, and structural bombs do not disarm themselves. Rule 7, understand that this is not the end. Even if COMEX survives January, the same dynamics return in February. Even if they manage a controlled detonation, the next wave of demand will hit an even weaker structure. So this is not a 1-month story. This is a 6-month to 12-month story. And the $50 billion bomb is just the first explosion. There will be more. So here's where we are. $50 billion in silver exposure sitting on COMEX, 15-to-1 leverage, 50 million ounces in registered inventory, 750 million ounces in paper claims. And the January effect is hitting right now. They want you to believe the paper market is stable. They want you to believe COMEX can handle anything. They want you to believe $50 billion is just a number, but the math does not lie. The leverage is real. The inventory is shrinking. The demand is surging, and the bomb is armed. The only question is, which trigger sets it off? A large institutional delivery, an Asian buying surge, a margin hike that backfires, an ETF redemption wave, a geopolitical shock. It only takes one. And once the bomb goes off, the entire market changes. Paper becomes irrelevant. Physical becomes everything. And the $50 billion explosion becomes the story that defines the silver market in 2026. So the question is simple. Are you holding paper or are you holding metal? Because in the next 30 days, only one of those survives. If you want the next video, I will break down the exact warning signs to watch for in the next 7 days, how to interpret registered inventory data, and what it looks like when a delivery squeeze actually starts. Comment below. Do you think COMEX survives January, or is the $50 billion bomb about to blow? And remember, this is educational analysis, not financial advice. The fuse is lit. The clock is ticking, and the only safe place is on the scarce side of the market. Which side are you on?